SJREIA is New Jersey's largest nonprofit real estate investors association. We have over 850 members. We at South Jersey Real Estate Investors Association want to welcome you to our group. We are a nonprofit real estate educational association covering all of New Jersey and one of the largest groups in the United States. SJREIA's goal is to help our members find success and build wealth through real estate endeavors by providing educational and networking opportunities.
Membership entitles you to discounts and cashback programs from Home Depot. With membership, you get your own private website to show off your wholesale properties and/or rental vacancies. Through your private website, you can collect contact information for buyers, sellers, and renters and add them to your sphere of influence. With membership, we connect you with businesses that provide cabinets, appliances, car rentals, for example. Most of our local vetted business affiliates are excellent members to consider for your real estate investment team. These are only a few ways to help members.
While we are very self-sufficient in New Jersey, on a larger scale, we also include national REIA.org benefits, even more discounted services to add to your investment team. SJREIA has a members-only networking and educational chat forum accessible 24/7. You can be connected with seasoned investors, wholesalers, rehabbers, and contractors through our network. We'll have access to knowledge from hundreds of real estate investors all over New Jersey.
We have weekly and monthly meetings, either live in person or via Zoom. In our monthly meetings, we invite local and national speakers to present or have panels of investors to answer real estate investment questions. At our weekly meetings, either in person or via Zoom, you will learn about specific investment strategies in local markets. We have 2 Saturday meetings for mentoring and networking. We cover all topics real estate investors are interested in, including landlording, wholesaling, notes, tax liens, just to name a few. SJREIA has multiple membership options. $150 a year for one individual, $175 a year for 2 household members, $20 a month for digital membership, and $495 a year for business affiliation. Refer to sjreia.org for more details about each membership type.
You can connect to us via email at info@sjreia.org or contact us through our website at www.sjreia.org. Even if you are not ready to join today, sign up for a free guest account to receive notifications of all our upcoming events. And as a reminder, there is no other place that you can go to meet and talk with over 850 like-minded individuals that are all interested in real estate investing. Every real estate investor should be connected to us. We look forward to meeting you and helping you with your real estate investing career and a long and prosperous relationship.
SJREIA does not exist to render and does not give legal, tax, economic, investment, or financial advice. SJREIA disclaims all liability for the actions or inactions taken or not as a result of communications from or to its members, officers, directors, and employees.
Tonight's guest is Martin Chera from Express Capital Finance, and he's got a ton of good, valuable information for us. I'm going to pass the buck to him. He's going to show us a couple slides, do his thing. If anybody has questions, you can type them in the chat, and then after we're all done, he can go through. We'll ask the questions and get our answers then. All right, Martin, you're up.
Thank you. Thank you, everyone. And thank you, South Jersey REIA, for making this networking event. So my name is Martin Chera. My company is Express Capital Financing, and I thank everyone for coming out there, and I hope everyone voted. We're going to hopefully be discussing 2 topics. The first one is about Rental 360, which is permanent financing. So I'm going to go through the slides. If you have any questions, like he says, please put them on the Q&A or the chat below. And of course, always seek your attorney or legal or accountant or tax advisor for your own due diligence. I'm just here to provide some basic information from a lender and from an investor perspective. So ECF is my company, Express Capital Financing, and it's about Rental 360, which is 30-year permanent financing. That's me on the left. The name is wrong. I apologize for that. I'm Martin, and my son on the Max is on the right side. He's one of the director of sales. Just to let you know, we've been around for about 13 years. We're a father and a two-son team. We are direct lenders that specialize in fix and flips, rental 360, which is really a 1 to 4 30-year perm. And then we do construction, ground up, as well as permanent financing for commercial properties and the 1 to 4s. So what's the philosophy of leveraging other people's money? It's about leverage. It's about the return on the investment and your cash on cash, which we're going to go into right now. But OPM just really stands for other people's money. It's a very common term. And when you put down as little as possible, I'm going to show you how and where the return on the investments are greater. So if you're ready to buy an investment in today's, market conditions right now, it's no real answer. I believe, as Bigger Pockets and other great investors say, spend time in the market, don't time the market. You got a 50% chance it could go up. You got a 50% chance it may go down. Nobody has that crystal ball, but at least you was buying now. When I say now, it could be today, November 8th, and it could be next week, November 17th, or next year. Just now is now. So if you're ready to buy an investment, well, you're going to need to know that you could stomach it, have somewhat of knowledge and capacity. You have your down payment money. I'm going to go through the pros and cons of buying an investment property. And again, it's just basic information. What type of loans are out there for investors, calculating debt service loans, which I'm going to go through, and how to calculate your return on the investment, and then ways to find real estate investment. So things to consider: are you financially stable? So Rental 360, like I said, it's a debt service loan. Typical terms are 20 to 25% down. So if you're financially stable, that has that 20-25% down on that particular property that you may have found, then you're financially stable. Now, keep in mind, you're going to have third-party closing costs, title, insurance, and lender fees. There is no exact real number. I mean, if a property cost you 100 and you got 25,000, great. You got your 20-25% down. I would allocate an extra 10 to 15,000 between a lender and third-party fees. Is the return on the investment there? Are you an investor that's strictly looking at the return on the investment, or are you looking for cash flow, which is the passive income? Or you understand that today's market, you may have a not such a great cash flow coming in, but you're buying it for the appreciation component. Do you have time to manage a property, or do you want to hire a property management company? I don't want to get really to the property managements. We call them PMs. However, do your homework, do your due diligence with property managers, talk to them, talk to their other customers and clients, find out how many clients they have, what area do they service. Maybe they're a PM that does multifamilies, 20 and 30 and 40 and 50 doors, and they're just too large for you, but they want your business. You could be a small pie in a big ocean. So you want to, kind of vet out the property manager. Housing market, is it going up? Is it going down? We all know that prices are somewhat going down. It's not going down tremendously like people think. Some areas and states and cities, it's even going higher. Some sectors, they're stable, and some are going down about 5 or 10% a year. And, even some states that we lend in, we're seeing a 20-25% drop. However, nationally, we're studying the markets, and we're seeing about a 5 to 10% decrease in values in some major markets. Do you buy a property yourself, or do you go with a partner? My philosophy, again, is if you don't know, better to do a deal with 50% of something better than 100% of nothing. But when you're going with the partner who either maybe you found the deal and he's got the experience, or maybe you got the money and he's got the deal. So you may want to partner up, because experience will, provide you the greatest asset, which is the experience. It's a learning curve like anything else. I want to just jump to a sidetrack of 1 minute. Some people, I talk to hundreds of people every day as a lender, and a lot of investors, oh, I'm just going to wait. I'm just going to wait. The rates are so high. The prices may come down more. And like I said, you want to spend time in the market, even if you don't have the capacity now, which is maybe the financing or whatever you don't have available yet. Start to study your market, see what's happening, whether it's the taxes, the insurance, your area that you're in. Are the prices going down? Are they going up? What does the realtor say? The neighbors say? Look up particular comps in the neighborhood, and you could do a lot of other research on the internet to see about that particular city and state and property type that you're looking at. So buying by yourself or buying with a partner, it's a good idea to think about it now before you actually step in. Another thing is you don't want to find a property, not have a lender, not have a title, and possibly not have a partner if you don't have all the money or the expertise. So having your, everything lined up so you could start your investment strategy, it behooves you to start it now. Property taxes, I mean, everybody knows that they're only going up. But believe it or not, there are some cities here, counties, I should say, in New Jersey, where I live right now, that you could also, look for tax abatements to get them down. Maybe you could talk to the county clerk's office and see if there's any type of incentives if you were to invest in that particular property or that particular, county. So, like I said before, there's pros and cons to buying and investment properties. Obviously, the first one is ability to use other people's money. And again, it's all about leverage. And leverage is if a property is 100,000 and your lender's going to give you 80%, he's basically giving you 80% leverage, and you're only putting down 20%, which is $20,000. It reduces the volatility in the market between stocks and bonds and in real estate investment and other types of investments, Bitcoin or whatever it may be. So real estate investment happens to be one of the greatest strategies out there, and it reduces the volatility out there that's in the market today. For real estate investors, there's a few other benefits here, which is unparalleled tax benefits. When you buy a property, again, for $100,000, the IRS, not to ask you, but they kind of demand it. It's called forced depreciation that they allow you to take. And that's basically taking, again, $100,000 property over 27 and a half years. It amounts to $2,750. Instead of giving it to the government, that amount, $2,750, is deducted off your income, that you don't have to pay income on that. So it helps you being an investor. Of course, the appreciation potential, where when prices are going up 5, 10, 15, 20%, that value is always going up. I should say the property is always going up in value. And the cash flow, which is the passive income. Now, some folks are somewhat afraid to buy. They're saying that prices may come down, are going down. I get it. But if you look at the historical real estate values, and whenever they did go down, whether it's a recession or, God forbid, a depression, they still always go up after we get out of, that particular situation. Any investment, any properties that you looked up, they always went up in value after, some time. So the cons is a steep learning curve for the newbies, hiring a property manager if and when you decide to do so. Should you not? It's a question really if you can handle it and you have the time and the patience. If you're a person that's working, 8 hours, 12-hour day and 5, 6 days a week, and you don't have that capacity to talk to your tenants and collect the rents and go to courts, then you may want to hire that PM. Yes, they will take 5, 10% of the annual gross income. It's very standard out there. In the beginning stages of my career, I did it all myself, and I learned the hard way. I was in retail, and I couldn't focus on anything. I couldn't focus on my properties, and I couldn't focus on my retail. And about 2 years later, I decided to hire a property manager. I made mistakes, unfortunately, and I learned from my mistakes, who was good, who was no good, where did they hurt me here, and where did I need to correct myself on hiring a future property manager. You're going to have carrying costs, of course, on the properties, taxes and insurance, and God forbid if rents go down and whatever your income is, you're going to have to carry that carrying cost, and that's going to be your monthly mortgage payment. And if there's still a shortfall, how about the taxes and insurance on the property? So these are possible carrying costs that you may have to incur if the rents don't cover it. If there's some type of a market, I'm not going to say correction because we're in a correction right now, but some type of a market, a recession or something like that. Exit strategy. Well, we're talking about Rental 360, which is a 30-year perm. So basically that's what you're doing. You're looking to go into purchasing a property for the passive income and or the appreciation, like I said, and of course the forced depreciation. So your exit is really, you're going to be keeping it. Believe it or not, some people are calling me in the past week or two. They want to, the prepays, just to go into it for a minute, are typically 5-year step down, which means a 5, 4, 3, 2, 1. In the next 25 years, you have no prepay. Or you could take what's called a 3-year step down, which is a 3, 2, 1. And now these days we have a 0 prepay or a 1-year prepay. So a lot of the investors that are coming out of hard money and they wanted to keep the property for, 10, 20, 30 years are deciding, they have to pay off their hard money lender, but they know they have to go into perm, but they would rather have a 1-year prepay or 0 prepay. That's good options for you to know. So that's a good thing for your investment strategy or maybe your exit strategy. Okay, what types of loans or financing products are out there for your investment properties? Well, you can go conventional, unconventional. Those are Fannie Mae and Freddie Mac loans. Unconventional, I believe that's for I don't really do those, but I think that's for the 20% down. I think you have to have a score of about a 650. These are more made for homeowners, and we call them owner occs. And then number 3, which is the hard and private money lenders, which we are. You can tap into your home equity line or home equity loan, and that is called a HELOC. So it's a home equity line of credit. If you're looking to buy an investment property, so you could use your home equity line, go to your bank, ask them to use the equity for your property, and hope they'll get you approved, God willing. The good thing is right now, I believe the rates are in the 4s, maybe 5s today's, I don't know. But the good thing is you could tap into if you don't have any personal cash, you could tap into your home equity line at 4 or 5%, so you can buy your first investment property. Keep in mind, everybody, that if you're using your home equity line for your deposit, plus a lender for that 80 to 75%, you are typically you're doing 100% financing. Is it risky? Talk to your accountant and your attorney. I'm just going to tell you, it is very risky. And for a lot of reasons, whether it's the debt service, whether, God forbid, like I said before, the rents go down, maybe the values go down, you're going to have to be coming up with 2 mortgage payments, the lender plus your HELOC. In these particular times, I wouldn't advise it ever to do it. You never want to be over leveraged in any type of, investment strategy. But that's up to you guys, what you want to do. Commercial investment property loans. Commercial loans are multifamily, mixed use, shopping centers, industrials, and warehouse. And number 6 is a portfolio loan. So we call that a blanket or portfolio. It just means many properties of single families up to 4 units. You could have multiple properties in one particular city or state. We require 2 property minimum, 150,000 loan amount minimum. So you could buy 2 properties or 200 properties. We could do it all under a portfolio loan. Nothing better on the rate. Nothing better on the leverage. Really, it's just the flexibility of having 1 payment a month instead of 20 payments on your 20 properties. Okay, so like I mentioned before, calculating debt service. Debt service is you take the net operating income and you divide it over the total debt service. So, for example, which I'm going to show you in the next page, but for easy, math, let's say your income on the property is 40 grand and your expenses, taxes, and insurance is 20 grand. Well, your NOI is 20 grand. 40 minus 20 is 20. Now you take that 20 grand minus it over the total debt service. Keep in mind that 20,000 that we deducted on the 40 includes taxes and insurance. So in this case, we're just taking the total debt service of your principal and interest payment. So you could do it really two ways, but I'm going to show you in a minute. But just for clarity, again, you take that 40 minus the 20, which is taxes and insurance. You're left with a net operating income of $20,000. And assuming your principal and interest is I don't know, $15,000, that will give you your debt service. It's basically, like I see on the bottom, it's taking your income and the expenses. And it is also, I couldn't see that last sentence, but okay. Okay, so here's a classic example. This is a little bit old, folks, but it's a good example. If you take a purchase price of $250,000, assuming we're lending the person 75% leverage, that loan amount is going to be $187,500. Principal and interest is $1,006. He's got a $3,200 a year in taxes and insurance. Okay. And if you look at the monthly income, the monthly rent is $1,700. So now we're taking that principal and interest, plus we're adding in that $3,200, of which comes out to $266 a month. That is a principal, interest, taxes, and insurance payment of $1,272. So in this case now, you got two choices. You could take $1,700, which is your gross, and this will be your PITI, principal, interest, taxes, and insurance, or you could take this minus the $3,200 in taxes and insurance, and that comes out to $17,200. And again, then you could take your P&I, 1,006 multiplied by 12, you get a yearly principal and interest of $12,072. So if you take $17,200 divided by $12,072, you get the same thing, a 1.33 debt service. So you could take it on a monthly basis, you could take it on a yearly basis. Lenders today on a debt service loan on 1 to 4s typically want a 1.20. They don't do lower, some do, we do. We can go as low as 1.00. However, most of them do want a 1.20 like us also. What's the difference? Well, if your income is $1,700 and your principal, interest, and taxes and insurance is $1,700, that is a 1.0 debt service. You have nothing left over for a rainy day. And by the way, that 1.2 is really just 20% more we want in income versus your PITI payment, principal, interest, taxes, and insurance. It's really just 20% more. For simple math, again, if your rent is, if your mortgage payment is $1,000, we want the rent to be $1,200. Okay. So that's how we do that. That's the debt service. So why? So if you said, I said before, I could go as low as 1.0, meaning that property is breaking even. Yeah, but you're going to pay a little bit higher in the rate. Today's rates are somewhere in the 8s. You're going to pay slightly higher rate to be at a 1.0. And the reason why is because lenders that are doing that are taking a greater risk. That's the reason why. So that's why it's a higher rate. Okay. But most lenders, to be in a normal rate, today's market rate of about 8%, they want a 1.20. I'm going to jump back a minute, folks. I want to bring to your attention something that I did forget. Besides having tax benefits and the appreciation potential and the cash flow potential, by the way, cash flow, this is called passive income. When you're working at a job, that is ordinary income. That is taxable at a much higher rate than a property at passive income. I believe it's anywhere between 25 to 40% on an ordinary income. This is passive income, as it's a much lower, since it's a business. Also, something else is here. You want to put your properties under an entity, whether it's an LLC, S Corp, C Corp, some type of a corporation or entity, because when you do that, you're limiting your liability risk. Something happens to the property, somebody falls down, now they're only going to sue the entity, they don't sue you, and that becomes a shell. You're shelling yourself from any exposure. So keep in mind when you're doing that, and when you are doing investment properties of 1 to 4 using a debt service, all lenders want it under an entity. So it also protects you from liability, but all lenders do want that. So keep that in mind. Why? When you're going into contract. Okay. Return on the investment measures how much money or profit is made on the investment as a percentage of the cost investment. So in my, my explanation is if you have 100,000 cash and that property is going to make you 100,000 in profit, well, you made 100% return on the investment. 100,000 in all money cash, and you're going to make $100,000 net. You made 100% on the deal. Now take a rental loan. Imagine that same deal where you're putting in 20%, $20,000, and the same deal, it's making you 100 grand. Well, you just made on your 20 grand, 500%. Now you may say, well, what's the difference? I have 100 grand. Let me put it into this one deal. And I don't want to do any other investments. But think about it. You're taking all your eggs, you're putting it into one basket. Like we said, the market could go up and down, and you're not diversifying. You want to have utility. You want to diversify your personal income, your personal savings, and put it into multiple assets or multiple deals. You don't ever want to imagine the same deal of 100,000 purchase and 100,000 profit. Imagine you did 5 of them. Now that 500% turned into 2,500% return on the investment. Not every deal is going to bring you the same ROI, and that's why you want to diversify. So I'm just telling you how to other people's money is leverage, because you want to take your personal cash, your personal capital, diversify into multiple assets. So just the last bullet on the bottom, other variables can affect your ROI, which is any cost going in, which is closing costs, title, insurance, a lender's fee, repairs and maintenance. All this could, bottom line, affect your return on the investment. Okay. So it's a simple enough, you keep in mind that there are a number of variables that come into play with the real estate affecting the ROI. Again, you could have repairs, maintenance, and expenses and other types methods that's figuring out your leverage. And by the way, you never figure out your rate or monthly payment or mortgage payment to determine your ROI. Every financing product and program is different. So you don't ever include, if I'm putting in 100,000 and, well, you know what, it cost me X amount of dollars to close on the deal because of this particular rate and all that. You don't include that in there, because it's just, you have to include your soft cost of the down payment and your closing cost to determine your ROI. Okay. So for another example, you paid $100,000 for a rental property and the closing cost was $1,000, and you fixed it up for $9 grand. So now you're into the property for $110,000. You got $12,000 in yearly rent, $1,000 a month. 12 months is $1,000. You include the water, taxes, insurance, and all that. And again, let's assume for the example it's $2,400. So you take the annual rent of $12,000 minus $2,400. That's a $9,600 NOI. And then you take your $9,600 and you divide it by all your cash, $110,000, and your NOI becomes 0.87. Yes, sorry, 1 second, guys. It becomes 8.7. So that's if you're doing it all cash. Now watch when you're leveraging. Same deal, $100,000, you put down 20%. So, and your closing cost is, again, just for an example, is $2,500 up front, $9,000, same deal, $9,000 for the remodeling. And so you got your 20% down, you got your $2,500 plus the $9,000 in rehab, you're in out of pocket $31,500. Again, this is a little bit old, but assuming the rate was 6% at $80,000, your principal and interest would be $479.64. If we add that $200 per month to cover the water, taxes, and insurance, now your monthly payment would be $679.64. $679. Your income is $12,000 for the year. Your monthly cash flow is going to be $320. And if you look at on the right side, your ROI is 12.2. You put down a total of 31.5 versus $110,000. So look how the ROI went from 8.6 to 12.2. That's a 4 points higher on the ROI. The greater the ROI, the greater, your money is working for you. And that's what you want to see. Okay. So other factors to consider when you're doing an investment property. So the market value of the property minus the total loan amount, repairs or maintenance costs, vacancies, particularly in between tenants. There is no normal, I guess 5 to 10% you want to include as a vacancy cost, even though you could be in an area that's, a 2% vacancy rate. For your sake, to determine the return on the investment, to determine your, what you want as cash flow, I would put in a 5 or 10% projection. And there, always stress test your deals. Even if your rents are a certain dollar amount, I would, project it at a 5 or 10% less, even on the rents. Rents may go down, who knows? They are going down slightly, but are they going to go down more? Nobody knows. So whether you want to finance or mortgage, the less cash paid out front as a down payment on the property, like example before, that 31.5, the larger the loan balance is going to be, of course, because you're leveraging, the greater your return on the investment. However, like the first, scenario, the more cash up front, which is the 110,000, the less you borrow, which was nothing, the lower your return on the investment is going to be, since your initial cost would be much higher. Okay. How do you find properties? Well, there's a lot of ways to find properties, a lot of ways. So I'm going to tell you what's over here. I know you all could see it. Obviously, spread the word. Tell everybody that you're starting out, or whether you're an experienced investor, friends, families, realtors, bankers, going to networking groups. You may want to put ads in newspaper. Again, this is a little bit old, but you may want to put ads in newspapers. You maybe want to do some bandit signs on the grass, on the corner of people's houses. We buy houses all cash. We can close in a week. Maybe you want to do door knocking. Maybe you could also do the brochures on the doorknobs. You leave them over there. So, you could use real estate websites such as REIQ. We have some other affiliate partners on our website, which I'll show you after. But networking with other real estate professionals. And again, it could be a realtor, banker, lawyer, developer, flipper. Any one of those will, networking will increase your chances of finding a property. As far as hiring a real estate agent, I get asked a lot of times, oh, I'm paying retail. But if you're new, what's the problem? Pay the retail. What's the big problem anyway? Your realtor's going to know the market. She's going to know the as-is value. She's going to know the ARV, which is an after repair value. And she's going to know what the rents will typically be. And if she doesn't, she'll tell you what websites to go to and help you. But just to give you an idea of some good websites to go to, are, you can go to Zillow, Trulia, you can go to Redfin. All these are great websites to go to check out property values, rental comps, and things like that. So let me just see if I skipped anything here important. Okay. So I'm going to go to another slide if, Mark and Chuck, you're okay with that, but I'll just go quickly what I do. Again, that rental 360 is 1 to 4 units permanent. Loan amount 75K up to 5 million. I'm sorry. Right now, the rates are somewhere in their 8s. Believe it or not, this is a good, oops, I'm sorry about that. The rates are somewhere, second. Okay, the rates are today in the 8% range. But the good thing is our scores now are down to a 620. Okay. Again, we'd like to be at a 1.20 where you could be in the 8s. However, lenders like me, if you have 1.0 up to 1.19, you're going to pay about 1% higher. But the good thing is you could do it. Loan to value, forgive me, this is a little bit, okay, it is good. Purchases, you can get up to 80%. And if it's a cash out, up to 75%. So we are good with that. Any questions, Mark, that you want to tell me about before I go to the next slide?
So John Lewis asked, when can you do a refi after a renovation? Do you need leases in place or something else? Like
Great question.
when is
Great
it
question.
possible?
Okay, so typically lenders on a debt service are anywhere from 3 months to, and above. My product is 3 months. We can use the as-is value. We prefer 6 months, but if there's a situation that needs to be done in month 4, which is after the 3 months, we could do it. And the reason why is lenders want the property to be seasoned. It wants it to, have you in hands for those few months of owning it. It wants you to collect the rents. It wants to make sure that everything is stable, where we can kind of use the ARV or the new as-is value. So I hope that answers your question.
So only after 3 months. So if I buy a property, 3 months, I buy it, I throw a tenant in there, they've been in there for 3 months, you're willing to start giving me a cash out refinance after that?
Yes, we could do a cash out after in month 4, basically. Yes. Now we could do in the first 3 months, but we're going to give you 80% of the project cost. So let's say you're in for 100,000 purchase, 20,000 rehab. We'll lend you 80% of that $120,000 in the first 3 months. It may not be enough to get you out of your current loan, but you have that option too.
Okay. And then I know why John is asking this question. We were both at the Cincinnati event for the Ohio REIA this past weekend, and there was a gentleman there talking about land trust. And then also Ron Odom was talking about land trust last night at our meeting at the Empire Diner as a way to have complete anonymity. But the question arose, will the bank lend if your property is in a land trust? If I title it in a land trust, would you lend me that money still?
If it's in a land trust,
Trust,
yes, we
right?
do lend to trust. We always like to look at them before you actually even send us the deal. So,
Okay.
but we do lend to trust as long as it's irrevocable.
It has to be an irrevocable land trust, because one of the things they were saying last night was so in order to protect myself, I'm going to take my name off the property. I'm going to take my properties, put them in a land trust, but I want it to be a revocable land trust because I want to be able to change the beneficiary or change the trustee or whatever. So that's what Ron Odom was talking about last night. You want to have it a revocable land trust. And the gentleman we saw this past weekend was saying a similar thing, and he gave us the impression that if I already have a loan existing, the bank doesn't care. I'm paying on the loan. If I put it in a trust, as long as I still pay, there's a very slim chance they're going to call the loan due. But the question is, what if I buy it and put it in a land trust and it's a revocable land trust? Will you be able to lend on that? And one of them had said that the bank doesn't really care about the trust. The loan is going to you as the beneficiary. So you're kind of saying, hey, I'm going to pay this loan, and they're basing it more on that. Is that correct? Or is
It sounds correct, yes. And as far as the irrevocable, I could be incorrect on that. I would have to talk to my staff tomorrow. But I do know whether it's irrevocable or revocable. We just always like to look at it, and we'll give you an answer in 15 minutes.
Okay.
All righty.
All right. That looks like the only questions we have. Again, if anybody has questions, feel free to write them in the chat. Otherwise, if you have other slides, you have anything else you want to show? Or
yeah, I'll do a quick another one just to give other people here some more insight. But Mark, I wanted to talk for a minute. Maybe just like to do a quick one-on-one, me and you, and maybe with Jim and Chuck out there, and get everybody's expectations. Like, where are the rents going these days? Where is the market values going these days? Just like a quick 2 minutes. What are your thoughts, Mark?
Yeah. So I have about 25 doors here. I'm down in Franklinville, New Jersey. you know, rents just went through the roof. And just the people that I talk to, you know, in my circle, everyone is telling me like, hey, I had a house that rented for 1,500 and the tenant moved out and now I'm renting it for 2,000, or just like crazy numbers. Um, Here I'm seeing a little squeeze as, you know, the tenants that I have in there complaining a little, they can't afford it. And I also spoke with Mike Bonadies of Terra Vestra, and his opinion was that it's going to level off and maybe drop a little bit. And his reasoning was that people aren't going to be able to afford it. You know, even though minimum wage got up, you can, you know, we could say, hey, the expenses are higher, taxes went up, you know, my contractor costs went up, and I gotta make up for that. I'm gonna raise the rent to do that, which is what we're doing. But at the same time, if the tenant can't afford it, they can't afford it. You know, I can't get blood from a stone. So they're gonna either go out and be homeless, or somebody's going to have to lower their rent, you know, and eventually, and I tend to agree with Mike, it might be more of a supply and demand thing. Now the demand is so high and the supply is low, but as it gets to the point where people are going to say, hey, I just can't do this, they'll move into a smaller house or whatever, but eventually just they're not going to pay. And, you know, either they don't pay, they get evicted, you know, and if it gets to the point where, okay, no one's coming, well, guess what? I need my place rented. I'm going to, you know, if it gets to that, you know what? Maybe I go from 2,000 down to 1,900, or maybe I go from 15 down to 14, because, you know, 14 is better than nothing.
Of
I
course,
need to
of
have
course,
somebody
of
in there.
course, of course.
So it's really, I don't have the crystal ball, but that's kind of where I see it. And in talking with other guys, you know, it's been great. Hey, I'm getting a ton more rent, but I don't know that it's going to keep being great. It's going to get up there and then maybe level off and maybe dip down a little bit. That's my thought.
So, you know, and I appreciate you telling me that. I mean, just for everybody listening, my thoughts are, so if you noticed before I said a correction, the past year or two since since this pandemic, trillions of dollars were put into the economy. So everybody was out buying all kinds of things, from properties to personal items and everything. So we're in this how do I say, the inflation, but to me, markets, the values are going to be stabilized. So instead of going up 20, 25, 30, 35% in some areas, they're just going to go down to that normalcy again of, 3 to 10% a year. So it's correcting. It's not devaluating. It's just correcting itself. The past 2 years, we saw prices go up 20, 25, 30, like I said, anywhere to 40%. It was a bidding war. So now if it's going down to, if it's going to a 3 to a 10% increase per year, that is normalcy. Do not be scared of that. That's one thing I want to say. And just like I want to touch on what you said, yeah, the Affordability Act is gone. People can't afford these new rates to buy a property. They can't afford the more down payment that they have to put down, whether they're going conventional or debt service lender. So they're forced to put down more money. So now rents are only going to go higher, and yet there's less properties in the market too. So, it's a catch-22 with the rents. I'm just of the opinion, and again, my opinion, I'd rather, if I have a decent tenant, I will raise them a little bit, feel them out, and if they're good for it, great. And if they're not, I'll keep them the same, because 1 or 2 or 3 months of downtime and fixing it up and putting it on the market again and possibly paying a realtor's fee again, that could, affect your return on the investment, your cash flow. So sometimes it pays to keep a decent tenant, a good tenant, or of course a great tenant. But that's just my thought. So just to recap, that it's not crashing. And by the way, if we are in a recession, rents always increase. It's just statistically, it shows that. So I'm not sure if everybody, is familiar with that. I just wanted to share that with everybody. Okay.
Yeah, I agree. They're going to go up. And I just think that, like you said, that eventually it's going to be normal, 3%, whatever. But I think in the short term, They're going to level off, and maybe, and I don't think they're going to go down, like, oh, back down to, my $2,000 are going to go down to 1,500. But like you said, there's going to be landlords that are going to say, oh, you know what, I got this tenant, they really can't afford a $100 jump. I'm going to keep them right where they are. I don't want to have a turnover. I don't want those expenses. So that's where I think they'll level off and just say, okay, I'm going to level it off and be right there. And if it gets to the point where people are homeless, that's where it may dip a little. But again, nobody has a crystal ball.
And just last year's national average of rent increase was anywhere from 18 to about 37 to about almost 40% increase in rental increases. So again, if it goes to normalcy of 3 to 10% on an annual basis, it's normalcy. It's not decreasing. It's just going back to normal. So that's a good thing. That's a good thing. So just wanted to bring that out to everybody. Okay, so I appreciate that feedback, Mark. I appreciate that very much. This topic, I'll just go through it quickly. I don't want to bore everybody. Hopefully, this is informative information. This is about the BRRR. So this stands for buying, rehabbing, renting, refinancing, and repeating. So the first thing you have to do is go into hard money, and then eventually you go into the rental 360 or 30-year perm, or they call it a debt service loan. So this is what that's all about. Again, me and my son, Max. By the way, we're nationwide lenders. So I just want to let everybody know that. And we're direct, so we're not brokers or anything like that. And again, the philosophy is using other people's money to get a higher return on the investment. So whether you're doing a rate in a term refi or cashing out refi, the key to maximize your BRRR is to know your strategy beforehand, which is before you buy, knowing what you're doing, and of course, during your rehab. Don't say, I may sell it for the profit, excuse me, or I may refinance it if rates go down. It sounds like a normal exit, but you should know your exit, one of them right away, whether you're going to make a quick 30, 40, $50,000 on a rehab, or you know what, I want the cash flow, whether it's minimal now and later on greater. You want to know your exit beforehand. Going into a deal saying, you know what, if the rates go lower by the time I finish, I'll see where they're at, and if it's decent enough, I'll do the BRRR, and if not, I'll just sell it. It's not good, because you need to know what your profits are if you're gonna sell it. And you need to know if a debt service is enough if you're going to keep it. So this is important factors to know. So before you buy, find out how much the property is really worth post-rehab, which is, we call it the as-is value. Excuse me, what your property is worth post-rehab, which is the after-repair value. How do you find that out? Again, those websites that I gave you before. If you want to call me tomorrow, I'll give you some more, my websites that you can go to, and I'll give you those things. Before you buy, work with a realtor or a wholesaler or a landlord or developer to get, understand what that after repair value is. You might be surprised to find out the property is worth more, and then that's selling it rather than refinancing as an option. So that's why it's important to say, you know what, I'll make $100,000 on the rehab versus keeping it for the cash flow for $500 a month, $6,000 a year. You need to know your options and your thoughts beforehand so you can have a safe execution. Number two is find your lender before you close. You don't want to have a lender, a title company, and a possible attorney once you find the property. You always want to have it lined up. Yes, shop around, always look for the best terms if possible. But by the way, talking about shopping around, don't just talk to one lender, and when you're talking to lender 2, 3, and 4, you should openly tell them what they're giving you, because maybe that a lot of times people tell me, oh, your rates are 8 and I can get 7. But when I look at a term sheet, I see what the lender's doing, that they're adding on extra fees, which doesn't make sense for them to do it. So a good lender will advise you if it's a good deal, not a good deal. And if it's a good deal, I'm going to tell you stay with them. And if it's not a good deal, I'm going to tell you where the negatives are to keep you on the toes with them. But you always want to have your lender in place. You should have 2 or 3. Know their sweet spots. Maybe that lender doesn't do your particular city or state. Maybe his minimum or his maximum is 2, not in your criteria. So it's good for you to know that. Sorry, I just got a dry voice. Okay, so line up your lender, like I said, at least a month before when you're ready to refinance. So when you're doing the BRRR, I mean, my opinion, you should have your lender lined up even when you're buying the property, not really when it's a month before you're ready to go into the refinance. So just to go a little more into that, let's say your rehab is going to take you 6 months, even though this PowerPoint says, do it in your 5th month. Again, I'm not just saying as a lender, as an investor, you should have your lender in place when you're buying it, just where you know what you're doing. Yes, you could still shop around the 4th, 5th month before the 6th month is around, but you want to start knowing who you're talking to, their names, their phone numbers, and all that. You want to know the rate and terms, the prepayment penalty, other factors that go in, such as maybe their closing costs, their origination fee. Every lender is different, so that's good for you to know. Give me 1 second. I'm sorry, guys. Okay, so where are we at? Okay, you could all. So a realtor, by the way, like I said in my first PowerPoint, that they could be your great advisor and realtor because they can coach you on possible landmines. One of my investors, I introduced him to a realtor, and right across the street from the house that he was going to buy, they were tearing down their property and they're making a warehouse. And his exit strategy from the onset was to keep it for the cash flow. And that rent was going to be, I think, $1,500. I said, speak to the realtor, see what they think, and blah, 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 blah. And then, of course, do your own, due diligence. But it ended up that $1,500 a month, he determined that I was probably going to be anywhere from $1,000 to $1,200, because who would want to live next to a warehouse with 15 trucks coming in and out day in and day out? So these are good things to know before you go into a property, whether it's a realtor or your whatever it may be. Get pre-qualified for your refinance. And this is very, very, very important, especially if you're doing the BRRRR and especially with your bridge hard money lender. The reason why, if you're investing into a property for the BRRRR, we want to make sure that your exit, you're telling us you're going to keep it, that a debt service is for at least 1.20 or not. And if it doesn't, we're going to tell you it doesn't debt service. Well, again, we could do 1.0 to 1.19. However, if the debt service is not good, we're going to tell you the exit of refinancing is no good, not just for you, but for any end user, whether they're going to, buy it for their own selves, going to a bank or whatever it may be. So it's good to know this going in. Depending on the type of loan that you secure, the lender will want to review your credit score, debt to income, property equity. So be sure to get all the documents ready when you're buying a property. Hard money lenders, we don't look at debt to income. We don't look at tax returns, no W-2s. It's a hard money loan, which means it's a hard asset, which is the property asset. That's why it's called a hard money. Today, we call it fix and flip financing or bridge lending. The equity in the property, it's kind of meaningless because if you're buying it for 100, it's got to be worth at least $100,000. But just to let you know that. If you're working with a shorter BRRRR timeline, you can get pre-qualified for the refinance loans during your purchase price. Like I said, it behooves you, everybody here, to get to know those numbers today. And we tell our clients at debt services today, excuse me, at 8%, but we have to project 6 months later, a year later. If that rehab is going to take them 6 months to a year, we have to predict, we do a stress test at 9% and 10%, and not only see the debt service, we want to see the cash flow for us and for you. Maybe it's going to be a negative cash flow. Do you have that negative money to put in every month? And most investors don't want to do that. So if you're working with a longer BRRRR timeline, like over 6 months, you want to think about holding off and applying for the refinance when you're 30 days prior. You could do that, but again, you always want to know your strategy and you want to know your numbers up front so you can make an informed, profitable decision. Gather your documents. So this is great to know. So I'm going to go to the right side a minute because we're a non-bank lender and I want to show you the easiness of this, which is, okay, LLC articles. We only finance deals under an entity, whether it's a corporation or an LLC. So you want to have the operating agreement, articles of incorporation, and certificate of good standing. If you purchase the LLC within 12 months, you do not need number 3. It comes with the package automatically. After 12 months, we just want to make sure that that LLC is certified with the state. It typically costs anywhere from $50 to $100, depending on your state, just to make sure that your certificate is in good. Minimum score, like I said before, it was a 650, now it's a 620. 30-day closings, and we're a debt service lender only, no seasoning required on the purchase. So these are great advantages. And remember, putting it under an entity, you're limiting your liability risk and you're getting that forced depreciation over 27.5 years. And you could do multiple deals, multiple transactions with a debt service lender, where on the left side, we're going to go through these bullet points, but it's all based on your income. So whatever your income is, they're going to only give you loans, not only loan to values, but they're only going to give you a certain amount of loans to purchase so many properties. Where a non-bank lender, you could do a multiple amount of loans. We don't look at your income to qualify you. So on the left side, the bank is going to ask for W-2s, pay stubs, your personal tax returns, and your business. That's called global debt service. So they're not just looking at the property, they're looking at your personal, and that's called global debt service. Your bank statements, copy of the license, 60 to 90 days to close. I do know, again, this is old, that some banks will close in about 30 to 45 days, but you should know that some banks are 60 to 90. You will have to verify your liquidity, not just your deposit. I think it's 6 months of your first 6 months of payments and other variables. And the property has to be seasoned for 12 months if you're refinancing it. If you're refi, like I said before, it's only 3 months to use the as is or the after repair value. Schedule your appraisal with the lender. Actually, it's the opposite. I'm sorry. The lender will schedule the appraisal. You guys need to be out there with your appraisal. Don't just pay for it. Don't just, go there, meet the guy, talk to the guy, ask him questions. How far are you going? A mile, 2 miles? What particular comps are you using? Even if you don't know the answers, it's okay. Get his information. And this way, when you go back home, you should have that information. And if he's taking something that doesn't sound right or look right, you're going to call up your lender and say, you know what, I don't agree with him taking this particular property. It's too small. It's too big. He went 5 miles out. Why didn't he go 2 miles out? These are important things to know. And I always say, no matter whom you're meeting, whether it's Chuck, the home inspector, or your appraisal, whoever it may be, meet them, talk to them, get to know them, build up a relationship with them. Prep the appraisal, so get the property in order, of course. Make sure that the tenants are either not going to be there, or they're open to it, they're accepting it and all that. Just on a side note, as a hard money lender, any COVID issues, tenant issues, we could do an exterior for whether it's a fix and flip or the BRRRR. We could do, we could work around you for the appraisal. Ideally, you want to get the appraisal completed prior to the tenant moving in. Again, this is talking about the BRRRR is already started, where it's already rehabbed. So you want to get the appraisal guy in, seeing that what we call rent ready. All the appliances are in, it's painted, it's all furnished, it's ready to go. And now the appraisal comes in and sees a nice property or apartment. If you want to complete the appraisal after the tenant is in the place, incentivize the tenant to keep it clean, organize, a nice smell. This way it won't affect the any appraisal amounts. Like I said before, try to be always present for the appraisal. Okay, prepare a little package for the appraisal to help them understand what you have done with the property. It could be just a one-pager that you're giving him of any interior and exterior updates that you've done. The rehab, show him the scope of work, show him your construction budget, show him this stuff so he can now determine the new after repair value. Number 3 bullet is a one-page document of close comps in the area. Again, you can get it from Zillow, Trulia, all the other websites out there. When you're doing your research after repair value, whether it's on the purchase or now on the refi, take close in proximity properties, 2 to 3 miles, close in square footage, close in bedroom and bathroom count. Also important, the outside, the lot size. Is it a corner house? Is it in the middle of the block? This all matters with your comps. And if the appraisal does ask for any upgrades, whether it's permits, plans, show it to him, the before and after. This is, by the way, it's not just a haphazard conversation I'm showing you here right now. I've saved people a lot of time when they want to get to a closing quickly by having all this information up front, because you will look like a great seller and feel like a great, a great buyer, but also you're going to look good to the appraisal and to your lender. Following up with your lender, post appraisal to ensure that things are on track, which is also important. Call up your lender and say, okay, the appraisal came today. When are you expecting it back? When could we close on the deal? We don't mind those phone calls. We don't mind those emails. We'll get back to you. Just let you know also, we send out emails, automatic emails. The appraisal came today. We expect it back in 24 to 48 hours. It's in final underwriting or whatever it may be. But if you're not getting those conversations going, communication, definitely have it with your lender. Don't wait for them to call you or email you. It's only going to slow down your transaction. And so the left side, we already discussed as far as fix and flips, 100,000 minimum. Rates today, unfortunately, are in the 10%. It is an annual rate, so it's pro rata. So if you kept the deal out for 6 months, you only paid 5%. And the rate is minute because it's so short-term pro rata. It really has it has no strong bearings on your deal, not unless it's a very large size, loan size or project size. Credit scores, believe it or not, even though it's 650, we could work with people in the 500s. And we're one of the few lenders that do 90% of the purchase still and 100% of the rehab, as long as it doesn't exceed 75% of the after repair value. So that is my presentation. Any questions over there, Mark?
I had a question with regards to the LLC taking out the loan. Is there any guarantee, or do we have to sign any promissory notes or any guarantee, and does it go against your personal credit?
So, okay, so entities is the only way we fund hard money. Rental loans, we prefer them in an entity. It could be an individual if need be, but you will always sign a personal guarantee. Understand the lender is lending it to an entity. Even though it protects you for liability, it protects us from, God forbid, bankruptcy and foreclosure. So there always will be a personal guarantee. However, that personal guarantee is limited to that particular property, unless there's not enough funds to cover the total loan. Does that answer your question?
It does. And also, does it go against your personal credit?
Yeah, great question. So any of my financing does not appear on your personal credit. A mortgage, none of mine, whether it's short-term fix and flips or rentals, never appear in your personal credit. The only thing that's going to appear is the the credit report. That's all, the credit hit.
Thank you.
You got it.
So when you're doing a loan and I buy a property, you're loaning it to my LLC, but I'm going to sign for it also, but it's not going to hit my credit report?
Right. My mortgages will not show on your credit report, whether you owe me $100,000 or $2 million. The only thing that's going to show is that Express Capital Financing did a credit inquiry.
And
that's why the debt service loans are excellent, because we're not looking at the income and whatever's on your credit report. If you owe TD Bank and Bank of America, we don't care. It has no bearings. I'm sorry, go ahead.
Are there states that you don't lend
So
in?
yeah, there's about 5 or 6 states: North Dakota, South Dakota, Idaho. I don't remember the other 2 or 3 states, but it's not no states that people are going to do business in.
Okay. And do you loan for turnkey properties? Like I have some turnkey properties in Memphis and Arkansas. Like if I have a turnkey company sends me a property, can I give that to you and you check out the debt service ratio and you say, yeah, we could do that?
Yeah, I could do commercial properties, multifamily, mixed use, industrial, warehouse, all that. Yes. And then they 1 to 4s every day. Yes.
Nice. Very good. Very good. And yeah, and I agree what you were saying about gather your docs, because I've had a few loans in my time, and any smart investor should know, hey, get your documents together now, even before you talk to the lender, because or even after you get your first loan, you start gathering those documents and have them ready for the next one. you're
Yeah, we
gonna
have a customer of mine
provide me
he was approved on Friday, and as of today, he has not paid for his appraisal. They went out there. They need to release it to us. We want to close on Wednesday. And we're telling him, pay for it so we can get it, so we can close you on Wednesday. So communication is key with all your providers, very much
Yeah.
so.
Absolutely. All right. And so do you loan for residential properties over 4 units?
Yeah, that's multifamily, yes.
Okay, so you
Yes.
do that. And does anybody else have any questions? Either raise your hand or throw it in the chat. And if
X
not,
now. I mean, there's my information on the screen. If anybody wants to call tomorrow, I'll give you my my number. It's 201. Actually, I'll give you the main line, 718-285-0806. Again, that's 718-285-0806. You could press, I think it's 1 for sales, and a loan officer will reach out to you. If you want my personal cell number, it's 347-348-0262. So again, that's 347-348-0262. Anybody needs proof of funds so they could secure a bid, let me know. We'll have that conversation. That's very important to be qualified to a realtor, to a seller. And 99% of realtors will not take an offer unless you could show proof of funds. So we will do that for you. But it's more important about showing you the economics. I want to understand your needs, your goals, your strategies. Do you want it for the cash flow? Do you want it for the appreciation? Do you want it for the quick flip? So we're going to show you all those numbers out there so you can make an informed decision.
and Maddie Nash asked if you require a percentage for down payment. So I'm guessing you had said 20 to 25%.
So yeah, on the rental loan, which is the perm, it's going to be a minimum of 20% down. Actually, yeah, 20% down. And on the bridge financing, it's as low as 10% down for experienced borrowers.
Okay, and then
Now,
if I want
sorry.
a rental property, if I'm buying a rental property, you're going to look for 25% down or 20?
Well, look, the highest we could do is 80%. The only reason why it would be lower leverage is because of the score or because of the debt service. So what lowers leverages is 2 things on the rental loans: the credit score. Our minimum is a 650 with 65% leverage. But just to let you know, yes, lowering the leverage would be because of score and the debt service.
And does a higher score get you any better of a rate? So you're doing loans for people with 650. If I got a 750
Yeah, no,
or
the rates,
850 or whatever.
unfortunately, the rates are going to be maybe 10 bips higher or lower. Nothing much of a difference.
Right. Okay.
Nothing much of a difference.
So having that super credit score isn't going to help me much.
Well, a credit score will help you with leverage. Keep that in mind. Now, on the hard money, on the flip side, and when I say flip, it doesn't necessarily mean you have to flip it. You're just using the bridge financing to buy it and fix it up. We don't season your money. So wherever it comes from, cash, credit cards, HELOC, friends, we don't season your money. And we can always mix up somebody's credit score, somebody's money, and somebody's experience. So me, for example, let's say I got the experience and Mark, you got the money and Chuck's got the score. We can mix any of the 3 or all 3 to get a deal done. So it's not like it has to be one borrower with all 3.
Okay, good to know.
So with the proof of funds, is that on a per deal basis? Or is it something where, I understand what pre-qualified is. I understand what pre-approved is. Do you get pre-approved for a certain amount and that lasts for a certain duration, like a month, 2 months? Or do you do it on a per deal basis and say, Mr. Irving has proof of funds for this particular property?
Great. Who's asking that question, by the way?
David Irving.
Irving.
David, great question. So we could do it either one, property specific or a generic amount. As a lender, I do need to know what that borrower's liquidity is. And again, if they're doing a rental loan, I want to make sure that they got their 25% that they could show me. And if it's a bridge loan, that they got that, 10% down that they could show me. So we could do either one and then give them either one. but we always look at to see what you got, and then we're going to tell you what you're good for. So, for example, let's say you're good for 10% down on a bridge, and you're going to show me $100,000. Believe it or not, you could find a property. I'm going to give you a generic for 900,000 to $1 million. I'm not going to do it for exactly $1 million because that's your 100,000. That's your 10% down. You got closing costs. You got third party closing costs. So it's going to be roughly about 950, just to give you an example. Does that help you?
It does. Thank you.
You got it.
Yeah, so let me get that straight. So if I have $100,000 in the bank, that's 10% of $1 million. So I could come to you and say, look, here's my credit score. Here, look, I got $100,000. You can write me a pre-approval letter for 900,000, giving me that cushion that I could then, if I find a property for 600,000, they're going to say, oh yeah, he's pre-approved for 900, no problem.
Right. Now I'm going to tell you guys, it's a little bit, it could work in your favor and not work in your favor, because even though I'm giving you a POF for $1 million, but your property is 600 and you want to negotiate down, you're not at a good leverage point when you got a POF letter for $1 million. So I'll give it to my investors. It's not a problem, but it's better. That's why I like having a conversation. And sometimes what I'll do is I'll give you a POF for 600, 6.25 in for 650, or 600, 570 and 580. So I work with my investors. I'm here to build relationships up,
Yeah, that's a good point, because I've done that in the past myself, where I didn't want them to know that I have all this money. So I just said, hey, I got a proof of funds for, like you said, a lower amount. I got a proof of fund for, 150,000, because I know they're asking for 160 or 70. I just want them to know I'm approved for 150. So maybe they'll go for that.
Yep.
Say, well, you got 100 or you got 200,000. Why can't you buy it for 170?
Yeah, it never pays to put it into an exact amount of $1 million, but again, I'll have that conversation and I'll work around that investor. And if it's specific to a property, yeah, we'll put the address, the entity name, that dollar amount, and show the realtor right away. And you know what? Sometimes even realtors call me up after and say, is this guy good? I got this letter. And I'll say, yes, everything is fine. So,
Okay, and so John Lewis asked if he does a hard money reno loan with your firm and then do the rental loan, and he does that to the BRRR afterwards, is there a second set of closing costs?
Yeah, it is a second loan, of course. Yes. Okay. One is short term and one is long term, 30 years, of course. Yes. However, we do have reduced fees for the underwriting if you're going into the BRRR, the second loan after. Yes.
All right. Since you already got a ton of information.
And, I'm not sure what other states everybody's on, but we do have local appraisals in a lot of major states, New York, New Jersey, Texas, Florida. So, some lenders use what's called an AMC, an appraisal management company, which is good. It's fine. We use them also, but we also have local appraisals out in certain states. What that does is it shaves off some time, some days, and also some cost to the borrower. And everybody wants to close as quickly as possible, and that's what we're here for.
And is your typical closing 30 days?
On a permanent, yes, it takes about 30 to 40 days. On the fix and flip hard money, it takes about 10 days, 12 days on the first loan. Second deal and onward for that same borrower, 3 days.
Really?
Mm-hmm.
Impressive. There you go, everybody. Listen up.
And that's regardless. That's regardless of price point. That 3-day period.
Can you repeat that question again?
I said that's regardless of price point or value or the amount of the loan. That 3 days.
No, I didn't say 3. Oh, you mean on the second deal on the hard money is regardless? Yeah, it's regardless of the price. Yeah, the reason why it goes from 10 to 12 to 3 is because we already did underwriting on that client already, that investor. So now it's in the first deal, it's 50 the person and 50 on the deal. Now it's just 100% on the deal, and it just shaves off so many days.
Understood.
All right.
And so John is asking for fix and flip loans. Can you do a drive-by appraisal, or do you need a full interior inspection?
Yeah, so we would like to do an interior to protect our loans and protect the investor. However, like I said, whether it's COVID, tenants related, foreclosure, REO, and you just can't get in, we could do a exterior, we call it. So we could do exterior, interior, or a hybrid. A hybrid is where somebody just comes in quickly, takes pictures and videos, 5 minutes, he's out. And then he gives it to the actual appraiser in his office and he does all his work over there. So that's a hybrid. That also shaves off a few dollars and some time. So we got a lot of flexibility here for our investors.
And with regards to liquidity, if someone has a line of credit, you do not count that as liquid funds.
So for hard money bridge, we don't season the money. We don't season your money. So again, it comes from credit card, HELOC, cash, wherever it's coming from, we don't care. On the rental 360, which is the permanent, we do require 2 months of bank statements to show that the money is in the account for the purchase. Does that make sense?
Understood. Understood.
Yeah, because we're going to close you so quickly in 30 or 40 days. And if you have to start to transfer funds and borrow it from your parents and all that, it just, we see that the person doesn't have the time to close quickly and doesn't have the money. So we want to season in there for 60 days. Yes, 60 days. I said it right. No. It's 2 months of bank statements. So it's 30 days of seasoning.
So not to get cute here, but if I have a line of credit and I know I want to buy a property and I take that line out and I put it in my bank account for 3 months and then come to you.
The line of credit money, if you're doing a rental loan, the money has to be sitting in an entity for 60 days.
Okay.
You get to do a rental loan on a purchase.
Got it.
Okay.
Right, so I could take money out of my credit card or any kind of credit.
Wherever you take the money from, yeah, but just the money has to be sitting in that entity in order to do the purchase on a rental loan. Yes.
Right, so if it's in there for 60 days, if I give you 2 bank statements and it shows, hey, I have, $20,000, it's been sitting here for 2 months, then you could say, okay, I can give you your, loan for 80,000.
Even though I'm the owner, my underwriters require 2 months of bank statements, but if borrowers can't come up with it, but the money's there at least and you could show us, then we could work with that. But just typical underwriting is, 2 months of bank statements. Season.
All right.
And with regards to an LLC, if someone had just, gotten their articles of incorporation or just started out with the LLC, there's no issue with that as well.
You could still buy it today. It could be fresh coming in the mail. That's fine. As long as you give me a tax ID number and those paperwork that I said before. Yes.
Thank you.
You got it.
So there's no seasoning of the LLC. I could go to New Jersey Secretary of State website, get my LLC paperwork.
Yeah, you could buy it tonight. It'll come in the mail in 3 days or 10 days, as long as you give me the information, your tax ID number, your certificate of good standing, which they'll give you right on the website as soon as you make that purchase. And, if everybody listening also, each deal should be a separate entity. Your accountant and your legal advisor should tell you this, but I'm just recommending it because, again, exposure. If you got 10 properties in the one LLC, something happens to that property or somebody falls down, they're suing that LLC, which has got 10 properties now. So better to have each property under a separate LLC. Is it paperwork intense? Yes. Is it going to have more tax returns? Yes. It is more than well worth it.
Right. Okay. Anybody else? Any questions? If not, it is 8:23. We could probably end it here.
Okay. Good night, everyone.
Thanks everyone for their time. Thank you.
Okay. Thank you.
Thank you, Martin.
Thank you.
Pleasure.
Bye-bye.
Thank you, guys.
Okay. Bye-bye.
Hey, Mark,
Yes.
I'd like to just give you a phone call and talk offline. I'll probably do so tomorrow. Is any particular time good for you?
You can call me anytime. And so I am I am very spontaneous, maybe that's the word.
Okay.
If I'm not available, I'll get back to you, or I may know at that time, like, oh, you know what? Call me back in an hour, or hey, call me back in 5 minutes. Because I hate to tell you something now and then something comes up and it's like, oh, you know what? I got to run over here, run over there. But give me 1 second. I'll just take it. As far as I know, tomorrow I don't have anything going on. Let me just check. Yeah, tomorrow, just about any time, whatever works for you. And like I said, if I don't answer, I'll either call you right back or I will text you and say, hey, call me back in 10 minutes or an hour or whatever.
Sounds like a plan. And I have you at 609-381-5227.
Yes,
Perfect. Thank you so much.
you got it.
Hey,
Have a great
Mark.
night.
Mark, what was Martin's last name, please?
Chera, Chera, and it's on the website. If you go
Okay.
to the thing, you can
When I
see.
registered? Okay.
Yeah.
All righty. I'm gonna have a question for you when we get together on your Saturday morning,
Sure.
because you
sure,
said something tonight which sparked my curiosity.
sure,
So I want to talk,
absolutely.
when we get on your Zoom, we'll talk about it.
Sounds
Okay.
good. Sounds good.
Thank you.
All
Have a
right.
good night.
You too. See ya.
Thank you. Bye-bye.
Bye.